Accounting can seem confusing when you first start learning it, especially with terms like journals, ledgers, trial balances, and financial statements. By the end of this video, you'll understand what accounting actually is, how businesses record transactions, how journals and ledgers work, what the accounting equation means, and how companies create financial statements. Financial accounting is the process of recording, organizing, and summarizing a business's financial transactions. The purpose is to create financial statements that show how much money the business made, what it owns, what it owes, and how financially healthy the business is. These financial statements are used by business owners, investors, banks, governments, accountants, and managers. In accounting, transactions are the events that change the financial position of a business. Every time money, value, assets, or obligations move, an accounting transaction occurs. For example, buying equipment for the office, selling products or services, paying employee wages, receiving cash from customers, paying rent or utility bills, or even purchasing goods on credit. If a company buys inventory today and agrees to pay later, that is still a transaction because the business now has both an asset and a liability. Accounting uses something called double-entry bookkeeping. Each transaction affects at least two accounts in the accounting system. One account is debited, another account is credited, and the total debits must always equal the total credits. For example, when a business makes a sale, revenue increases and either cash or accounts receivable increases. This is the foundation of double-entry accounting, where every transaction has two sides that must stay balanced. The purpose of recording transactions is to create a complete financial history of the business. Accurate transaction recording allows companies to prepare financial statements, track performance, calculate profit, manage cash flow, and comply with tax and legal requirements. Without properly recording transactions, a business can't reliably understand its financial position. The entire accounting system is built around one very important formula called the accounting equation. Assets equals liabilities plus equity. Assets are things the business owns. Liabilities are amounts the business owes. Equity is the owner's share of the business. For example, if a business has £10,000 in assets and owes £4,000 to suppliers, then the owner's equity must be £6,000. The accounting equation must always balance. There are 6 main account types in accounting. Assets, things the business owns. For example, cash, property, plant and equipment, inventory, and accounts receivable. Liabilities are money the business owes. For example, loans, accounts payable, and taxes owed. Equity is the owner's investment in the business. Revenue is money earned from sales or services. Expenses are costs of running the business. For example, rent, wages, electricity. Dividends or drawings are money taken out by the owner or shareholders. Now let's talk about debits and credits. A very important rule in accounting is some accounts increase on the debit side and others increase on the credit side. Assets increase with debits. So when the business gets more cash, equipment, or inventory, we record a debit. Expenses also increase with debits. For example, when the business pays rent or wages, expenses go up with a debit. Drawings or dividends also increase with debits because money is being taken out by the owner. On the other hand, liabilities increase with credits. So if the business takes a loan or owes more money, we record a credit. Revenue increases with credits. When the business earns money from sales or services, revenue goes up with a credit. Equity also increases with credits because it represents the owner's claim in the business. A simple way to remember this is debit increases, assets, expenses, and drawings. Credit increases, liabilities, revenue, and equity. Before transactions go into the accounting records, Businesses usually have source documents like receipts, invoices, and bank statements. These documents provide evidence that a transaction happened. Accountants record transactions in the journal. Each journal entry shows the date, the accounts affected, the debit amount, the credit amount, and a short description. Every journal entry must follow the double entry rule. For every debit, there must be an equal credit. This keeps the accounting equation balanced. Let's look at a few transactions. Suppose the business earns £500 cash from sales. Cash is an asset, and assets increase with debits. Sales revenue increases with credits, so the journal entry is debit cash 500 and credit sales revenue. The business now has more cash and more revenue. Now suppose the business pays £200 for rent. Rent is an expense, and expenses increase with debits. Cash is decreasing, and assets decrease with credits. So the journal entry is debit rent expense 200 and credit cash 200. The business has paid money out, so cash decreases. Next example is buying equipment with cash. Suppose the business buys equipment for £1,000 cash. Equipment is an asset, so it increases with a debit. Cash is also an asset, but it is decreasing, so it is credited. The journal entry is debit equipment 1,000 and credit cash. One asset increases while another asset decreases. Next example is taking a loan. Suppose the business receives a £5,000 bank loan. Cash increases, so we debit cash. The loan is a liability, and liabilities increase with credits. The journal entry is debit cash 5,000 and credit loan payable. The business now has more cash, but also owes money. Let's look at the ledger. The general ledger is the main ledger of the business. It contains the summary balances for all accounts. A subsidiary ledger is a detailed supporting ledger. It contains individual records that support one account in the general ledger. So, the general ledger shows totals, while subsidiary ledgers show details. For example, the general ledger may contain one account called accounts receivable. That account shows the total amount owed by all customers combined. But the sales ledger, which is a subsidiary ledger, shows the individual balances for each customer. Suppose 3 customers owe money. John's Electronics owes £300, City Tech owes £500, Bright Stores owes £200. The sales ledger shows each customer separately. But in the general ledger, accounts receivable would simply show the total £1,000. The same idea applies to suppliers. The accounts payable account in the general ledger shows the total amount owed to suppliers. But the purchase ledger shows how much is owed to each individual supplier. Now let's look at the unadjusted trial balance. After all transactions have been recorded in the journal and posted to the ledger, accountants prepare something called the unadjusted trial balance. The trial balance is simply a list of all account balances at a specific date. Its main purpose is to check that total debits equal total credits. If the totals are equal, it suggests the books are mathematically balanced. To prepare the trial balance, we take the ending balance from each ledger account. Accounts with debit balances go in the debit column. Accounts with credit balances go in the credit column. Suppose the business has these ledger balances. We place them into the trial balance. Cash is £5,800 debit, equipment £2,000 debit, accounts receivable £2,200 debit, accounts payable £1,000 credit, loan payable £5,000 credit, sales revenue £2,000 credit. Business expenses £2,000 debit and owner's capital £4,000. Notice that total debits equal total credits at £12,000. That means the ledger is mathematically balanced. However, a balanced trial balance does not always mean there are no mistakes. For example, a transaction could be recorded in the wrong account, or both debit and credit amounts could be incorrect but still equal. The trial balance mainly checks the arithmetic accuracy of the accounting records. Before financial statements are prepared, Adjustments may be needed. Adjustments are important. Some revenues or expenses may belong to a different accounting period. It can be accrued expenses, prepaid expenses, depreciation, accrued revenue, or deferred revenue. Suppose rent of £200 relates to this month but hasn't been paid yet, or invoice hasn't been received. We need to make an adjustment. Debit rent expense £200 and credit accrued expenses £200. These adjustments help follow the matching accounting principle. Next adjustment is prepaid expenses. Prepaid expenses happen when a business pays for something in advance or is charged for a future period before receiving the full benefit. For example, suppose the business receives an insurance bill for £1,200 covering 12 months from February to January. When the bill is first recorded, the full £1,200 may be treated as an insurance expense. But at the end of the financial year in December, 1 month of that insurance, January, actually belongs to the next accounting period. Since £1,200 divided by 12 months equals £100 per month, the January portion of £100 has not yet been used. That £100 should not be treated as an expense this year. Instead, it becomes a prepaid expense, which is an asset. So we make an adjusting entry: debit prepaid insurance £100 and credit insurance expense. This adjustment reduces this year's expense and carries £100 forward into the next accounting period. This helps ensure expenses are recorded in the correct accounting period. Next adjustment is depreciation. Depreciation spreads the cost of a long-term asset over its useful life. For example, suppose our £2,000 worth equipment loses £500 value each year through use. We make an adjustment: debit depreciation expense £500 and credit accumulated depreciation £500. Depreciation expense increases expenses, while accumulated depreciation reduces the asset's book value. Now let's look at accrued and deferred revenue. Accrued revenue is revenue that the business has earned but has not yet received in cash or billed to the customer. For example, suppose a business provides consulting services worth £1,500 in December but didn't bill the customer yet. Because the service was provided in December, the revenue belongs to December's accounting period. Adjustment is debit accrued revenue £1,500 and credit service revenue. Deferred revenue is the opposite. Deferred revenue happens when the business receives cash before providing the service or product. In simple words, the money comes first, but the work has not been done yet. For example, suppose a customer pays £500 in advance for a subscription. At first, the business cannot record all £500 as revenue because it has not yet earned it. Instead, the amount is recorded as a liability called deferred revenue. So the adjusting entry is debit revenue £500 and credit deferred revenue. This creates the liability and reduces the revenue. Now that we have the adjusted trial balance, we can prepare the financial statements. We usually start with the profit and loss statement, also called the income statement. The purpose of the profit and loss statement is to calculate profit or loss for the period. To prepare it, we take all revenue accounts and all expense accounts. Revenue accounts are listed first. From our trial balance, sales revenue and service revenue £1,500. Total revenue equals £3,500. Next, we list expenses. Business expenses £2,100 and depreciation expense £500. Total expenses equal £2,600. Profit equals revenue minus expenses. Once profit is calculated, we move to the balance sheet. The balance sheet shows the financial position of the business at the end of the accounting period. It shows assets, liabilities, and equity. First, we list assets. Assets are things the business owns. From our adjusted trial balance, fixed assets, which is equipment and accumulated depreciation, cash, accounts receivable, prepaid expenses, and accrued revenue. Next, we list liabilities. Liabilities are amounts the business owes. These include accounts payable, loan, accrued expenses, and deferred revenue. Total liabilities equal £6,700. Finally, we calculate equity. We start with owner's capital, then we add net profit of £400. So total equity becomes £4,400. Then finish with the accounting equation. Now we check the accounting equation. Assets equals liabilities plus equity. £11,100 equals £6,700 plus £4,400. The balance sheet balances correctly. Profit and loss statement measures performance. Balance sheet measures financial position.